All right. Bring my slides up here. We get going. How's everyone doing this morning?
Uh, no complaints. It's a blessing.
Yeah, same here. Before we get started today, I did want to kind of go over some latest news in the investing and real estate space. As everyone already knows, we're kind of going through. I think we're coming up. We're already into week two of the government shutdown, and yeah, just seeing the impacts across the broader economy. I think here specifically, definitely in the Washington D.C. and Northern Virginia, Maryland area for sure. But other ramifications, I think of the federal government, only like 18 to 20% of the federal government employees are based here in the Washington D.C. area. So it kind of proliferates all across the broader U.S. with that. But one of the things, good news on the rate side of things, that rates continue to trend down. That the 30 fixed mortgage rate recently dipped to 6.3%, which is definitely good news for those that are in the market to buy real estate. It's the lowest in about a year. So over the last 12 months, we've kind of hovered around the 6.3, 6.2 has been the lowest that we've been within the last year. So that's definitely good news. It doesn't make housing cheap again, but it does offer a little bit of breathing room for consumers that are looking to buy. On the contract side, I know the data came out back in August. Pending home sales were up 4% month over month and up 3.8% year over year, which means people are getting under contract again. They're getting out buying. We'll see how long that lasts and what that actually means long term for real estate. But people are starting to transact more and recognizing that rates probably aren't dropping dramatically anytime soon. But there are still challenges that we're facing. Inflation is ticking up. Job loss is the unemployment rate is ticking up higher. We know the Federal Reserve, they're projecting that they're going to bring in a few more cuts before the end of the year just to try to bring things back in balance. And so we'll see if it's a little too late. I know the White House and the current administration has really been pushing for more aggressive rate cuts to the federal funds reserve rate. And so we'll just see what that impact will be long term on the economy. I think on the multifamily side, definitely some encouraging signs. Absorption is increasing in a lot of markets where you had new construction coming online. Vacancies are steady, and demand appears to be stabilizing. I know for my property in Montgomery, for our 96 units there, that we recently had a couple of evictions. I think we had three evictions that went off in the August timeframe, and I think all of one of those haven't been leased yet. And so after kind of having the contractors go in, do turnovers, that steady showings, the listings coming through, leveraging Facebook Marketplace is one that we've added probably about 2 years ago with that we've seen really good results with being able to advertise available vacant units on Facebook Marketplace with success. And so the absorption is still pretty good. It kind of slows down as you're going into the holidays. I know right now we don't have any new leases or leases coming up, which we didn't last year. We didn't assign any new leases November, December, and we don't have any leases renewing during November, December, which is great because just limited people are trying to move during the holidays, around Thanksgiving, around Christmas. People are wrapping up the year. They're not really looking to change locations if they don't have to, and so there's less renters that are looking for places to lease. So if you can get people in place before then, it's great. The same thing goes for like real estate transactions and sales. But those that may be looking to buy, find your next investment property, being aggressive during the holidays may be a great opportunity because there's less people looking. A lot of people are distracted. They're focused on the holidays. They're kind of wrapping up the year. And so, it may be an opportunity to make some offers on properties that are still sitting, or maybe get get going before people come back after the new year and really get active in your market. And so those are things that always to kind of consider. But at the end of the day, the markets are still trying to recalibrate and figure out where they are, find some balance. Opportunities still exist out there for putting deals together, and always, being able to stay on top of your buy box, your market, where you're looking at, what you're trying to invest in, is always an opportunity to build long-term success and win. With that, today, before we open up, I definitely want to kind of see, hey, let everyone give you some opportunities, over the last couple of weeks to share any wins that they have had. And that side, before we start talking about 1031 exchanges, and more in particular about Delaware Statutory Trust and just the benefits that that asset has with being a vehicle to build wealth and deferring taxes. So before we get started, I do want to open it up, just kind of say good morning to everyone, and yeah, and just see what wins that we have, anyone have going on that they'd like to share this morning. See, we got a couple familiar faces on the call. I know one for me, as I've kind of wrapping up service and really focusing in on the financial advising side. We had a really good conference in Las Vegas last week with our broker dealer, with innovation partners, and just really networking with other advisors, as well as talking to some fund managers that were in the room. Apollo, who's focusing on, I think they were doing a $150 million raise on self storage across Texas and right now, and as well as the Walton Group. We spoke with them last week, and a couple other conversations that we've had with other DST providers as well too, which is why this topic is top of mind, just for those that are doing 1031 exchanges, that are selling properties and looking to defer some of the capital gains tax that comes with long-term ownership, and selling properties for a huge profit, with finding opportunities and understanding just the benefits and some of the drawbacks with DSTs, with that, which is why I really wanted to bring this topic up and share that with you guys. So you have it on your radar as you're kind of changing, you're looking at revamping your portfolio, and you're maybe taking some chips off the table, diversifying, selling some of your assets, that the DSTs may be a vehicle that you can leverage to continue to build wealth with deferring taxes and not having to pay taxes. Because could you imagine if you had to pay multiple hundreds of thousands of dollars in taxes versus rolling that into another property tax free, and allowing that to grow for another 5, 10, 7 years, depending on your investment horizon. So it's definitely something that you should take into account. Let's see here, bring the slides back up, and we'll dive in this morning. And so really focusing in on why 1031 investors are really starting to take advantage of Delaware Statutory Trust. I think if you really go into it and dive in, that doing the 1031 exchanges are great, but you have to identify the handful of properties that you're going to invest the money into within 45 days of selling your property. And so we already know how limited the inventory has been across the U.S. over the last few years, especially if you start thinking about, if you're someone in California, you just sold a home for $2 million, or an apartment, and you may have a $2 million profit, and you're trying to defer those gains. Well, we already know there's a shortage of single family homes the last couple of years, but commercial real estate as well too, that it's even more scarce. And so if you have that much money, the capital that you have to place, and you have to find the right investment that's going to cash flow, that's in the right area, that has upside potential, potential for appreciation, then it could be hard to identify that right property within 45 days. And so that's where DSTs come in with that, and really being able to go through it. But understanding that where you are right now and kind of where the 1031s are, it may not be something or a tool that you can leverage right now today. But the thing is really having this in your toolbox and understanding that it's a vehicle that can help you. But with that, let's go to the next slide and move on and really start diving into it. So after almost 2 decades of me just buying my own real estate, kind of going through managing and turning over units, and then really just going into the pure asset management with like apartments that you realize that it can be tiresome. It's really not all that passive when you start talking about passive income. That usually when you're buying value add properties, and those are the opportunities that you have for appreciation. That it's work involved. That you have challenges that happen. You have vandalism. You have mismanagement of property managers that you have to fire and bring on new property managers, and you have to manage during that time frame when you have to make those transitions. And you're dealing with people. It's a people heavy business where you're collecting rent each month. People have lives, things happen. Um, People pass away in apartments. That's one that I've recently had to deal with, not personally, but with my property manager. He was the one on the ground, and so he was going through it and having to manage that situation. And so with that, you yeah, it's not as straightforward and passive as people like to always make it. And so I think that's one of the things that when you see more seasoned investors and those investors that are up in years and they're looking to kind of maybe relax, chill, get out of the day-to-day grind, that when you start looking at Delaware Statutory Trust, it's a vehicle that kind of gives them that peace of mind, because guess what? Between the tenants, the maintenance, the paperwork, it can start to feel like another job. And so that's where, being able to imagine the ability to generate consistent income without the late night calls, the constant repairs. And so it's a way to start investing a little bit more efficient. I won't say smartly, because the value add, and they allow you to build wealth. But as you change in your position in life, your investment goals change, your risk tolerance change, your ability to be hands on changes. And so I think that's one of the things that really appeals to a lot of individuals with it. So, what exactly is a Delaware statutory trust? So, a DST allows multiple investors to own fractional interest in professionally managed income producing real estate. Instead of buying it, if you really think about it, instead of buying, like, say, for instance, an entire property or entire apartment complex, you buy a fractional share of maybe a $50 million asset, like a large apartment building, an industrial complex, a medical office, or something along those lines. But the good thing about it, you have professional managers handling everything from the day to day. And it's almost, if you really want to think about it, it's like buying a stock in a real estate company, except it's backed by actual property, by the actual real estate. And so that's where really DSTs make their money, where they're powerful, where in regards to being fully passive, no management headaches, it's 1031 exchange compatible, so you can defer those capital gains, as I talked about a little bit earlier. And then you have that steady, predictable quarterly income, big properties, small checks, no stress. And so I think that's the big thing that draws a lot of people in, is they get hands out of the day-to-day management. And guess what? They're buying a professionally managed building. And with the professional management, you have all the things that come with it, with the economy of scale, having competent individuals on the ground that's managing the day to day, and and having a lot of the maintenance and a lot of the trades in house, and being able to get materials and HVACs and all those things for cheaper costs. It just all goes into professional management and being able to run that asset in a way where it maximizes returns for investors. So with that, we're kind of talking about what DSTs are, but who can invest in DSTs? And so usually you're going to be an accredited investor, which means you have a net worth over $1 million, or as a single individual, you have over the last 2 years, your income has been over 200,000, or as a couple, been over 300,000 jointly, and you expect to make that going into the future. Usually the minimum investment that you're going to see is around 100K. So usually you're going to have a property that you own, or on the 1031 side at least. You're going to have a property that you own for a while. You're going to have a large profit when you sell. And, so that's where usually over 100,000 isn't really a large amount when you think about some of the 1031 exchanges that happen, especially when you're looking at places like California, or Austin, Texas, or areas where you've had a large amount of appreciation in the last few years, that you're going to see a lot of individuals, especially, say, for instance, states that have double taxation, where California has one of the largest state taxes in America on top of the federal tax. and a host of other taxes. And so a lot of people are looking at ways that they can defer those taxes in those high tax states. And so being able to have a DST allows them to sell those properties, take in a lot of the capital, and roll into another opportunity. And so that's why you see a lot of people tie 1031s to DSTs. And you don't have to be in a DST. You don't have to be in the 1031 exchange to only invest in DSTs, but it's a great vehicle to help you defer those capital gains. And so that's where the real magic happens when you start looking at the how you compare the DSTs with the 1031 exchange, which is one of the most powerful tax deferred tools in the IRS tax code. And so with real estate, this happened on the single family side, and then it's not really just tied only to commercial real estate. But you can do a 1031 exchange if you sell a rental property that you've owned for at least a year, and you sell it if you make 50,000 or 100,000, that you can go and 1031 exchange it and go buy another single family rental, or go buy a property that you want to use for a short-term rental, or put it towards a down payment on an apartment complex, and then you go in and you bring in the remaining proceeds. And so there's different ways that you can do it. But normally when you sell an investment property, you owe capital gains tax, sometimes hundreds of thousands of dollars, depending on the original purchase price, and really depending on the profit, the level of appreciation that you've had over the years. And so, but when you roll that sale into a qualifying DST using the 1031 exchange, you defer all those capital gains, which is what it's all about with being able to build wealth. Can you imagine having to pay hundreds of thousands in taxes versus being able to defer that, roll into an investment, and it's building and appreciating and generating cash flow for the next 10, 20 years versus you handing over that $100,000 check to the government. Now that 100,000 is continuing to grow for another 10, 20 years, and you're deferring those taxes because you can keep deferring. You can buy real estate, own it, sell it, go a 1031 exchange, and then you can go through that process over and over and over again. And so a lot of times you see individuals as they get near retirement age that they've done multiple 1031 exchanges year over year over year. And so they have a large tax bill that's coming when they eventually stop deferring taxes. And so when you have those large amounts, being able to put into a $50 million DST deal makes sense. It's easy button. You're able to place this capital usually 4 or 5 days. It's not a really drawn out process. And it really solves a big problem with being able to defer taxes and hand off, these assets to the next generation versus having to go and write the big tax bill today. And so no more stressful property turnovers, no tight deadlines. You can move your gains into a professionally managed DST and start collecting steady passive income. So I think that's one of the big things that we're really looking at is how can we defer taxes? And really, when you look at the wealthy and the strategies that they have, the more financial plans that I dig into and look at, is the more that you're seeing, how do you navigate and build wealth with taxes taken into account? Because if you're not taking taxes into account, you can really, really mess yourself up long term where you can have unexpected tax bills that come up and that can really defer what you were looking to do in regards to the quality of life that you were going to have in retirement, but then also the legacy that you wanted to leave behind, the assets for those that you're leaving behind in your family. And so I think really understanding the taxes and how you can defer the taxes. We talked about 401ks a couple of weeks ago, and just the impact of like the Roth IRAs and the mega Roth transit transfers, where you can start moving money over when you're in a lower tax bracket and bringing it to a Roth component where now the money is starting to grow tax free versus tax deferred. And so just understanding different strategies and how all the assets that you have in your portfolio, how all that rolls up into your overall tax strategy is going to be critical to how you position yourself long term with building wealth. And so that's one of the things with understanding how you can actually practice this and put it into work. And so one of the big things is, really understanding from there, the pros of DST we talked about, but then also, there are some challenges or risks that come with it. One of the big things that you really go through is that now, and I'll take that back, that you will start with the pros where you have the quarterly income, you have the professional management. I talked about those long-term growth and, being able to be completely passive. You're not involved in the day-to-day management side of it. You have the appreciation. And of course, for those using the 1031 exchanges, you have the tax deferral. But I think one of the things is that there's no just all good things when we start thinking about the opportunities that DST, that there are some drawbacks, challenges that you have to navigate. That a lot of times these DSTs, they're large portfolios that you're buying into, multi-million-dollar portfolios, and so they are illiquid. And so some of the hold periods for these can be 5 to 10 years. I have seen one right now. Well, I won't say one. They have a couple different ones that are more focused on land banking, where they have a 3 to 5 year hold period, where they look to primarily their goal is 3 years, but it could delay out to 5 years, where they hold land. There isn't any cash flow attached to it. But over those 3 years, you're going to have anywhere from 20 to 30% potentially in appreciation in the land value when they look to sell it to developers. And so you just sit and hold the land, and then eventually they sell it to a builder that's coming in that area. And so you have some funds that aren't focused on income; they're more focused on appreciation with a shorter duration. But by and large, it's going to be illiquid. You can't come in a year later and say, "I want to sell my portion of the DST, my fractional ownership of this asset." And so it could be a long hold period. So depending on where you are in your journey, your retirement journey, what your goals are and what your plan is, that it may not align with the liquidity that you may need. And so your money may be locked away for a while. Limited control, we talked about that. That the sponsor, they manage all the day-to-day property decisions and operations. Sometimes with the DSTs, they're not allowed to go out and refinance and bring on new debt. So depending on their business structure and making sure that they have in long-term debt is really critical to long-term success. But then also market and economic risk, where vacancy rates, economic downturns, inflation impacts. Have a great day, bud. Do good. Uh, that you're going to have those impacts that you have to manage. And so understanding that now, we really talk about diversification, depending on how many other assets you have in your portfolio, you could have a large chunk of your wealth tied up in one single asset, and it's illiquid. And so that's one of the things, really looking at like holistically your entire portfolio, and you having this one sale. If this was the only property that you own or business that you own and you sold it, and now all of your capital is tied up into it, then maybe you don't want to put all your eggs in one basket, and you really do need to dig in into the liquidity when they're projecting they're going to sell, the management, the risk level with their business model, what they're doing in the area, the economy. So you want to take those things into account. And so understanding the vacancy rates and potential for downturns and the impact inflation may have on your asset, it's going to be really critical to making sure that you're making a really good decision. And then the regulatory risk with the exchange rules on the 1031 side, you want to make sure that you're working with a qualified intermediary, a QI, that's being taken custodian at closing, taking custody of those funds, and then making sure that they're keeping you in compliance as you're placing the capital in one of these DSTs. So those are things that you definitely want to think about when you're making these investments. That you're completely passive, but you don't want to be asleep at the wheel. You want to do your due diligence. Make sure that the business plan that the DST has, that they're aligned with your goals, that the operation team is really good, and making sure that long term that it fits your overall retirement plan and what you're trying to achieve. And so one of the things that, ways that you can kind of mitigate risk with all these is having the knowledge. So being able to network strategically. That's one of the things. I was talking with a qualified intermediary that does a lot of DST placements yesterday. And so looking to bring someone on from their firm to really come in and talk a little bit about just more in depth about some of the operational side of it with the DST providers, the GPs or general partners that operate these, with some of the things that they look at on that side of the house. Also talking to other 1031 specialists that they work through 1031s and how they go about uh, going about taking custody, making sure that they are a good steward of the funds, and making sure that investors aren't making mistakes when they're doing the 1031 exchanges and putting themselves in cross sideways with the IRS. And so some of those nuances, but then also talking with other syndicators, because there are syndicators that are 1031 exchange friendly as well too, which all that is simply just buying an apartment complex or a single asset, kind of like the DSTs, but their fund is set up in a way where they can accept 1031 capital. So those are out there as well too. Leveraging resources like the $1 million Coffee Hour, the Financial Freedom Network that we have, and just being able to have presentations like these, discussions like this. You have Bigger Pockets, you have other commercial real estate publications out there, attending events, webinars and conferences that talk about the different strategies, specifically DSTs, and then being able to just overall to gain that practical knowledge where you invest strategically. We talked about the good things with it, but we also talked about some of the challenges or the cons that go with DST, with being illiquid, with the long time, hold period, the management side of it, not being able to be involved in the decisions, and the risk that happens with a single asset, or the inflation or the economic risk that could potentially happen in those areas. That you want to be cognizant of all those things as you're going in, and you're really making an informed decision and understanding how this is going to sit in your portfolio long term with the decisions that you're making. So that's, I think, the key takeaways, that they're definitely great for generating passive income, as diversification, multiple properties, asset types that allows you to kind of get out of maybe one asset class that you were looking at, and maybe you can looking to go into a DST that maybe has multiple build to rent properties in it, or you could have a DST that owns multiple assets or apartment complexes in as you get into the larger ones, they can have multiple apartment complexes in one DST in different areas, where now you have diversification geographically. And so you just want to look at what are the goals that you're trying to achieve. Of course, the tax deferral is a great one with the 1031 exchanges. And then just looking at the long-term growth and the property appreciation. We're talking some of the operators that I'm seeing right now. You have funds that are coming out, not necessarily DSTs, but funds that are coming out that are focused on buying A-class new multifamily in hot growth markets. So Austin, Atlanta, as we're seeing a lot of absorption coming in, that they're buying these new construction buildings 20-30% below the initial sales price, that when they went under construction 2-3 years ago, that they're getting them at a 20-30% discount, just based off where interest rates are today compared on when the new construction started. So there's a lot of activity happening where you have some of these funds and DSTs that are out buying Class A prime real estate at a discount, which is going to set themselves up nicely over the next 3 to 5 years as all the uh, inventory is absorbed. And we all know construction has slowed down drastically the last 2+ years. That now we're going to be at the same place that we were a couple of years ago, when we didn't have a lot of inventory, and we're going to have a lot of demand for rentals, where people aren't looking to buy just because of the affordability gap is so large right now from home ownership, that more people are choosing to rent. They want to rent nicer places. And so for those that own multifamily, looking at self storage as an option as well too, in some of these areas, that with just the ability to generate cash flow there as well too is really good. And so that's the thing, that this is another kind of feather to put in your hat, another tool to add into the toolbox as you continue to grow your portfolio, and as you liquidate sale assets and look to move up, to be able to invest in DSTs and have a passive or truly passive component in your portfolio is going to be great. And so of course, we love to have a conversation with you guys as you're looking to roll this into what it is that you're building with your portfolio. And really, I encourage you guys to consider having a comprehensive financial plan put together that's looking at your income, your expenses, maybe your military pension, your VA disability, your
Is it just me, or is Johnny frozen?
Yep, I'm back.
Oh,
Yeah, I'm back. I didn't my computer died on. I knew I was supposed to charge that up and totally went over my head. But that was it. That was it. The presentation for today, to really talk about DSTs and just the power of the 1031 exchange deferrals, and another opportunity for passive investing that I think is really a really good tool to have in your toolbox.
all right.
Yep. Any questions? Anyone has anyone done a invest in a DST or did a 1031 exchange?
We just had a 1031 come in on one of our syndications on our last deal.
Nice.
Awesome.
Yeah.
How did you guys set up? How did you have to set up the deal in a way where it allowed 1031 money to kind of pool with the other investors?
Yeah, we just did the tick and all that. So yep.
Okay. Yeah, when he says so, the tenants in common setup, so it's a way that you can set up your funds or your deals in a way where you can accept the 1031. So that's one of the big things is being able to say that you have ownership or that fractional ownership where the IRS allow you to partake in those deals. So no, that's awesome. Do you guys see a lot of individuals using 1031 that are looking to try to invest with you?
Um, yeah, we've talked to a number of people over the years and all that, but yeah, I mean, I think but this was our first one. I know some other syndicators have seen a lot more 1031s kind of come in. It definitely does kind of I can see how because we've had this 1031 was decent size. It was 1.6 million. But others that we've had other 1031 people, hey, I've got, and not just, I mean, it's still a lot of money, but hey, I've got 200 or 300K or whatever. And
Mhm.
there are a lot of hoops, involved and there's, a good bit of cost and all that associated with everything too. So I can we've always been told that by attorneys that you really want for a syndication, you really want 1031s to kind of start at 500,000 to 1 million. So for it to make sense.
Gotcha. No, thanks for sharing that. Yeah, I think that's with the nuances. And so a lot of times people will look at and say, with the DSTs or, with syndications that the fees, but there's a lot of legal work and there's a lot that the team that manages the assets has to go through in order to set it up, everything up into compliance with oversight and audits and things like that. And so a lot of the fees that you see that come with the managing these assets that it's for a reason because there's a lot of scrutiny and a lot of compliance that has to come on the front end and back end as you're operating, to do it the right way. No, thanks for sharing that, Dustin.
Uh, well, I was going to tack it on too, and that's where we've been told. I've never put anything into a DST before, but kind of, when you're under that syndication threshold, like say you're, like you mentioned earlier, 100K, 200K, 300K, that's where the DSTs might make a lot more sense.
Gotcha. That's a good point. And that's the thing is just really getting out here and understanding and meeting operators, meeting some of the custodians that are out here and understanding the different ways that you can grow your money because there are a lot of ways. That's one of the things that I've learned over the years that, I was narrowly focused on single family and then eventually evolved into multifamily. And the more you get out here, like, man, like the wealthy and investors out here, that there are a lot of ways that you can grow your money, that you can invest, partner alongside other companies and other businesses. Because when you really think about it, all the stock market is companies taking other people's funds and then they're investing into their bottom line. They're taking the money and they're reinvesting it to grow the business. And it's the same thing that, when you look at an apartment complex or a syndication, that all this is just business growth and a business plan. And you really having trust and confidence in the operators or the leadership team of the business that you're giving your money. It's the same reason you invest in Tesla, the same reason that you're investing in NVIDIA or Microsoft or Google. It's the leadership team, their business plan, what they're talking about they're going to do in the future and how they're going to generate a profit. And the same thing should be how you're looking at investing in some of these DSTs, these syndications. And there's so many other conversations out here. I know we have a call here at 9 o'clock with Goldman Sachs that's kind of walking us through their passive income portfolio suite with different private credit, private equity opportunities that they have out there. And so the thing I encourage is continue to learn, Tony Robbins' book, The Holy Grail of Investing, is really good. I think it came out February last year, and it really opened my eyes to a lot of these alternative investments. It really was one of the things that gave me I would say confidence, but I would say probably that nudged me into the financial advising space and really seeing the opportunities on how people have built wealth with these uncorrelated and alternative investments with private equity, private credit, and looking at DSTs. That's one piece of it, and just these other alternative ways of building wealth outside of just the stock market, just stocks and bonds that you think about. That there are a lot of different tools out here that we can be leveraging to build wealth, which is great. And that's really one of the things that with REI Jeans is really just bringing and exposing a lot of this to the Main Street level, just letting you know that there's different ways, more efficient ways to build wealth, and yeah, and give you that true diversification that everybody's seeking. So awesome. Anyone else?
I
I know we
see
still.
Adam is.
Hey, thanks, Faye. Yeah, question to Dustin and to Johnny here on Dustin, what you said about 1031 is minimum $500,000 to $1 million type of thing. Over the last year, I've been working on tax credits, and the tax credit market for solar tax credits essentially exists at $2 million and up, and there's very few below that. And what we found is that it's not difficult; you just got to learn it kind of on your own. That way you're not paying a bajillion dollars to lawyers and whatever else to do what they've been trained to do. But the tax rules are not complex. You just got to go hunt for them. And, using ChatGPT to find those rules and understand them, and then just asking a question to a lawyer or an accountant every now and then has kind of opened up much smaller piece of the market. So my question is that $500,000 to $1 million minimum for a 1031? Is that just kind of the way it's always been? Or is there a whole lot of paperwork that is required to be filed by a lawyer, which isn't really required to be filed by a lawyer, but you just can't turn a profit on it unless you're moving, those kind of big sums of money over?
Yeah, from what I saw, and I'd have to go back and look at the settlement statement. So I'm kind of given a estimate on the cost, but I'd say the legal costs were probably in that 20 to 30K range for that 1.6 million. And so if you're just looking at percentage of fees for whatever equities coming in, let's just say I'll just pick on the 100K example. If you're bringing in 100K 1031 and you have 30K in fees or even 25K in fees, it doesn't really make a whole lot of sense. But if it's $500,000 or maybe hopefully kind of maybe even larger than that, and I think it starts to make a lot of sense. And it's from what I saw, it's quite a bit of it's not a ton of work, but it is an additional layer of complication in the deal as well. So anyways, just throwing all that out there.
No, thanks. That's good. I've got no experience with 1031s or DSTs. Like I'm familiar with them, but I've never done them. So I'm not telling you what you should or shouldn't do. I'm just asking questions. So thanks for that.
Yeah, thanks for sharing that, Dustin. I haven't personally done a 1031 exchange. I think that was one of the big things after starting really picking up more volume on the flipping in like the 2018, 2019 timeframe, that my strategy really to avoid having to do 1031s really centered on the 100% bonus depreciation that came around with the 2017 tax law. And after I bought my first apartment in 2020 and just saw the amount of first year depreciation that you could pull forward, that really offset taxes in a way where I didn't have to take all the capital from a flip and roll it into one property, that you could take and realize some of those profits and defer a lot of the taxes that way. But no, I definitely, I think that's one to kind of look at, where's the cost benefit, where you do that analysis where the juice is worth the squeeze. And, in some syndicators and some deals, they won't take, they have minimums for a reason, just because, it's a lot more paperwork, and they want to get bigger checks, whereas that they don't have to continue to raise routinely. If you're getting small $25,000 checks, that it could take forever to raise. And so a lot of times you'll have those limits that are kind of placed on there, just where it is a lot of paperwork. And it just depending, if you're raising $5 million and you're letting people come in as low as 25K, then it could take a long time versus having a higher minimum that allows you to be able to bring people in at a larger amount. Because a lot of times, especially with like maybe if they're new with you, a lot of people, they may defer to a lower amount if they can with beginning the deal. I think that's why you have to continue to shop around and make good decisions on kind of what works best for you, and just how much liquidity you need and how much of your overall portfolio this one investment is going to be. No, great conversation. Great question, Adam. Adam, did you get a chance to make it out to the conference that was there in San Antonio last week at all?
I did. I was only there for about 2 or 3 hours due to family stuff here in San Antonio. But met a KC-46 pilot. We're going to try and reconnect and stuff like that, and then met some of the companies that were there. I've got follow-up to do probably after Tuesday of next week, just with the schedule going on, stuff like that. So I was glad I was able to get out, even if for a short period of time. And it looked like they were teaching a lot of the same stuff that I have kind of learned over the last year as well. Talking, hey, what's a security, Reg D, all that kind of stuff. So what I saw from that, not being a part of the community, was if you're interested in real estate, but you're brand new to it, that would be a good kind of crash course to learn about stuff over a 2-day period to kind of, launch yourself in the right direction, as opposed to starting out blind and then figuring stuff out the hard way over months or years or whatever else. So it looked like something very interesting for people getting into real estate, and something that I'm going to follow along, as well as, my journey is, attached to real estate type of stuff.
Yep, most definitely. It's always good to get out, network, and see the different companies, other investors, and I think that's the big thing, like-minded investors, that people that have the same mindset as you, and really kind of the approach and kind of trying to figure it out and put options together. So I think that's great. That's what it's all about.
And some of the stuff, and this kind of, tails along the 1031 stuff you're talking about today, is that, you can use, a tax credit to offset a tax bill if you can't meet that, that timeline for a 1031 exchange, or if you want to get out of the real estate business, or an investment, whatever else. One thing I've learned about 1031s and DSTs is the tax code incentivizes you that once you're into real estate, you just can never leave it.
Yeah.
You just never you
Right.
die and you hand your portfolio off to your kids with no taxes.
Yeah.
But as soon as you're like, I'm tired of dealing with renters, and I know people are, a smart way to get out, whether it's via DST or, like I said, I've been learning about, tax credits. So I'm not trying to toot my own horn or push my own stuff, but I would say a smart exit is important if you're going to exit, or you just stay on the real estate train until you die, which is fine because it's tax free.
Yep. Yep. No, great point. And it's all about the taxes. Like, if you really think about how much we really pay in taxes for the federal tax, state tax, we pay taxes on our gas, we pay taxes on our food, sales tax, that you start looking up, like the largest expense that you have isn't your home. It's you got to pay property tax. In Virginia, you got to pay personal property tax. Like, when you add up all these taxes, it's well over 50% of what you're paying out could easily be going, if you're in a New Jersey or New York or California, could easily be going to taxes. So the more you can figure out and focus on how you can defer or not have to pay taxes at all and grow your money tax free, like that is the impact. When you start looking at like the health savings account, the education, the Coverdales and the 529 plans, it's all about deferring the money that you're going to spend anyway, but deferring it and making it grow tax-free where you can pay for some of these expenses you got to pay for with tax-free money. And so the more that you really focus in on that, the better off you're going to be long-term.
I came across a defense technology founder. I'm in the defense technology kind of space as well. And one of the ways that he incentivizes his employees is not just with 401k matching, but he does like HSA matching. So it's a way to grow your investments. It's a way to cover medical expenses if you need it, but you don't limit it. And apparently he says his employees friggin' love it because it essentially, I think he covers down to essentially what your premiums are throughout the year. So essentially he's paying your medical premiums monthly, max. I forgot what it is. I've got, I don't know. But as you're growing your team, Johnny, I assume you have employees and stuff like that. I know you do. That might be a way to further incentivize retention and provide benefits that is tax advantageous as well.
Yeah, no, most definitely. That's a great point. And that's, being able to keep talent, things like that. That's right now at the crux of why the government is shut down right now. About, people are complaining about their healthcare premiums 2 and 3x and so we're at a standstill right now with where Congress is at and what they're going to do in regards to, some of the rules that were enacted a couple years ago. I think the big beautiful bill that now with the increase in Medicare, that now it's time for those impacts to happen and be realized. And some people and their constituents don't like it. And so we're going to see how it plays out. But healthcare is a really big deal. And it's crazy how, the Obamacare or, ACA from way back in 2008, that we're still talking about that now today. And the ramifications of what that means with healthcare for individuals, because it is a large expense for a lot of families. And like you said, TRICARE, us as veterans and active duty military members, that we're not part of the broader conversation. And it's one thing that we haven't had to really think about. But I think for a lot of like private civilians, citizens, it's a big deal.
It's a big deal. Yeah.
I think we have a question from Earl.
Awesome.
I think this is Earl. Is DST similar to REITs? REITs?
In a way, but the big thing with the REITs that they're not going to pass down you're not going to have the depreciation side of it. And you don't have the fractional ownership, which is why you don't see like the 1031 money being able to be placed in that, just because you don't have that fractional ownership. And usually with the REITs, that they're a pass through of their income, but they're not passing through the depreciation, the tax benefits that really come with the ownership, which is why you can really do like-kind exchange of the 1031, because you still have fractional ownership, so you still get your portion of the depreciation that's allowed. But yeah, no, great question. Yeah, the REITs have that advantage where you're buying a share of the company, and they have to pass through at least 90% of the income generated. It has to flow down to the REIT members, but you lose that depreciation aspect of it. No, great question.
Johnny, I'm curious about the limits. So you mentioned about so you have to be an accredited investor or 100K minimum. Is that right?
Yeah. Usually, it fluctuates. You can find some that's not an ultimatum. That's not like written into law or anything. So if you have a smaller 1031 exchange, then yeah, you could probably find a DST that would accept your money.
Gotcha. Okay. And so what does the paperwork include? What happens if anything happens within the 5 to 10 years? You talked about illiquidity, right?
Mm-hmm.
So is it going to be passed on, kind of writing down your beneficiaries if any case happened to the main shareholder or something?
Oh, of course. Yeah, you're going to have that beneficiary, whether it's, the trust and the estate plan, that has to be one of, because like your ownership, whether you're like owning a business or, whatever it is, however you set up your estate, if it flows into a trust, maybe you're investing, as a LLC and the trust owns the LLC. So you can still have those estate planning type of how you take title and how things flow down. Because, if you owned it as your personal name, then it would just go into your estate if you didn't have a trust, if you didn't have, those things set up in place. So
Will it be the same as if it were you, or it's going to be a different
yeah. Yeah, because you essentially you own that portion of the real estate, just like if you own this, you owned your home, that you're going to have
okay.
a title to that fractional piece of the property. And so it's you're the owner of it and the asset. And so whether you own it in your LLC or your personal name, you need to kind of walk through and talk that out with your estate plan attorney, your CPA, to make sure that you're doing that in a way that it kind of fits in with your overall estate plan. But yeah, so yeah, you definitely kind of take that into account as you're kind of building it out.
So it's better to have actually to do state planning along when you're doing all these diversification too.
Oh yeah, you want to have that top of mind as you're going through and doing anything with how you're taking title. If you're buying new properties, making sure that you're adding it to your trust, that you have your will in place, things like that, and that you have your beneficiaries and how you want to take ownership and how you want things to flow down.
Mm.
Once you have your day, your final day comes, that have everything in a place where your your goals and your wishes that you want to have implemented at your death, that you have that all that documented properly in the trust on how you want things to flow, how you want things to be owned, and how you wanted things to be kind of managed. And that's the trust is the vehicle usually that most use to kind of set that up in a way.
All right.
No, great question. And that's why it's great. You got to have your professionals on your team, your CPA, when you start talking about taxes, your financial advisor, your attorney. And so that's the thing. When you start building wealth, that you got to have the right people around you that understand the laws, the loopholes, the strategies that you can implement and what others are implementing to help you build wealth and help you protect it and preserve it. And being able to defer taxes and not have to pay taxes every time you transact is a huge way that goes into continue to build that wealth and keeping the acceleration and momentum going in your portfolio.
Yeah.
Yep, I know we're approaching an hour. I got to get ready for this 9 o'clock meeting, but no, great conversation. Definitely hop on my calendar if I can be of service and connect there. And I think next week definitely invite out any commercial real estate multifamily owners. We're going to have a company. I met Randy last month in Texas when I was there, and his company goes out and they do due diligence on commercial real estate and free. I will add free due diligence reports on your property. So the exterior document, the roofs, the age, the condition of the properties, and essentially to build a baseline for your property. So when you have a claim, because you're going to eventually have a claim as your own, that whether it's weather, hurricane, tornado damage, that you have a baseline of the condition of the property, and they have a 95% success rate with handing those reports over, working with the insurance and contractors to successfully negotiate claims for damage to properties. And so it's really cool. They have software where they manage damage, they manage weather, and they have a risk factor that looks at the weather over time in your area to know, hey, you probably have some damage to your property based off weather over the years and things like that. And so they use technology that can drive, hey, there's probably time for a claim, whether it's 5, 7 years of looking at the history in your area, your weather history over the time in your area to put that together to let you know where you're going. And they help people manage the claim. And that's how they kind of get paid, working with contractors and the insurance claim to make sure you're successful with getting the property. I won't say reimbursed, but made whole from the insurance. That's what it's in place for. So that'll be a great conversation. Them sharing uh, their business model and how they've been successful with helping property owners in that space. Because from someone who's had battles with the insurance companies and lost battles, I would add, and some good that, on the insurance side that is definitely value add and something that you need to be able to have when you're having those conversations with your insurance company on what the condition was pre-storm and after storm. That having that baseline will go a long way for making your case and being successful.
Nice. One last question, Johnny, before just one last. We're gonna be talking about private equity the following, not next week, but the following one, right?
Yes. Yep, that's the plan.
Yeah, we'll is because I'm reading the book that you mentioned earlier by Tony Robbins, The Holy
Mm.
Grail. So is the basketball thing gonna be included in there? When you invest,
We're buying the sports teams.
yep.
Yeah,
Oh,
yeah, I
sport
can.
teams.
Yeah, we can mention that. That's at a whole nother level. But yeah, that's
Okay.
a whole nother level, and we're talking through that one. But yeah, that's part of it. With wealthy individuals looking at buying a sports team, it's completely diversified from other assets and other asset classes, and they
Got
look at that as a way to kind of continue to grow their wealth.
all right. Yeah. Well, if you're gonna be buying one, which team are you gonna buy?
I'm a little ways away from there. But it would be cool to put a group together, maybe buy a WNBA team that's expanded to a
Oh
city.
yeah.
I think who was that? Somebody just bought one. They bought a WNBA team for like 10 million or something, and it's like they 10x their investment over the last couple of years. But yeah, no,
All right.
cool. All right, I gotta run. Thanks,
Okay.
everyone.
Thanks,
Talk
guys. See
soon.
you next Wednesday. Bye, everyone.
Bye bye.
Bye.